Today, folks, come join me as we review the mega cap Canadian dividend stocks posting earnings today with spattered performance. Power Corporation gave us real insight into Wealthsimple, Canada's fastest growing trading platform, and it's nothing short of astonishing as a very boring wealth management insurance provider that is Power Corporation is trading like a tech stock right now, up over 60% year to date. We'll talk about Northland Power cutting its dividend. It is a pure play renewable utility that's crashing today. In contrast to Hydro One, Hydro One's a great utility that's crushing it. We'll talk about Telus. Telus increased their dividend on the back of somebody that's not supposed to be able to afford their dividend. And I'm going to give you some full insight into all of this. If you're on a path to financial independence, if you want to retire early, all I ask in return is on the last few years of this incredible journey we've done together is simply hit that subscribe button and join me, guys. I'd greatly appreciate it. But Power Corporation now over $70 a share, up 61%, and another 6% just this week alone. I don't care about any aspect of this company's businesses except for what is going on with Wealthsimple. Wealthsimple has been just capturing the imaginations of millennials and younger, absolutely destroying traditional banking that just will not cut their commission trading. They will not give any real incentives, and they're losing a mass amount of market share, and we're seeing it here, right? And even right now, if you transfer $100,000 to Wealthsimple, they might give you a free iPhone or a MacBook, which is incredible, but you see the growth here. I mean, up 94% in assets under management. Wealthsimple went from $52 billion to over $100 billion for the first time in Q3 of 2025 here, guys. That is incredible, and something tells me that they're going to be probably one of the largest trading platform, if they're probably going to become the largest trading platform in this entire country and just amass the financials, the traditional financials like Royal Bank and TD and Scotia, because they can't compete with this, man. It's incredible. Like commission-free trading, and they're our version of Robinhood. And again, Power Corporation owns 51% of the controlling voting shares, and they even bought more shares recently. So just in the last little bit here, their value of their shares increased 47%, going from $997 million to $1.5 billion. And basically, on October 27th, Wealthsimple announced an equity round of up to $750 million. Bothers me I'm not rich enough to get involved in this. Like, if I could just own some outright shares of Wealthsimple, I would just be throwing capital at it. This allowed Power Corporation and IGM to participate, which IGM is an extension of Power Corporation, and they offered a $200 million. So they're continuing to increase their shareholder their share ownership in Wealthsimple. And we just take a look at the earnings themselves. And again, I don't claim to be like a genius when it comes to insurance companies. I don't really understand them all that well. Still, year over year, their net earnings were up 89%, guys. So if we take a look at the book value per share, and what I like about financial institutions is they can just kind of give you a full view of what, if they had to liquidate everything today, what is the actual value of the assets they hold and the cash they hold. And right now, the book value is $36.74 for Power Corporation, and the stock's at $71. So it's not trading cheaply by an assets an underlying asset value, but for the growth that we're getting here, I mean, it's nothing short of incredible, right? So we'll see if this can sustain, but their dividend has been great too, doubling their dividend over the last decade. I wouldn't be surprised if we get another dividend increase here soon as well. If we take a look at Manulife, however, again, I'm not saying I understand insurance companies at all, but Manulife has amassed an all-time high coming out of the 2008 financial crisis. Also trading at a favorable value. It's a bit more expensive than it historically has been, but again, guys, we've been in a weird growth cycle. And I would say this earnings period has not been that incredible. I mean, the core earnings were up 10%, but the earnings per share up 2%. Nothing too crazy other than we did see a nice little bump on their book value per share that jumped 7% to $26.07 per share. Again, Manulife's trading at $48. These are some of the larger disconnects for these financial companies between, again, those assets, the underlying asset values. If you compare it to, say, REITs right now, REITs are getting devastated, and most of them are trading well below their net asset values. So you can kind of use this as a gauge to when things are trading maybe more favorable to buy, but still, you can't really associate it directly because, like Power Corporation, as an example, could continue to grow excessively for the next 5 years, which means they could really easily grow into that book value. But I don't know. Like I said, it's to each their own how you want to value insurance companies and asset management companies. So I'll leave that one up to you. I'm not the biggest fan. Northland Power, however, I was a huge fan of this company. It was one of the first stocks I ever bought next to Canopy Growth Corp literally a decade ago. I traded these companies incredibly successfully, buying them back in 2014 and 2015. I sold out of all of my individual stocks for the most part in 2022, and Northland Power was on that list after being in my portfolio for several years. At least I doubled my money on it, and I sold it at the most opportune time because, man, the stock has been just devastated, dropping 26% just in the last 5 days alone on the announcement that they're cutting their dividend by a pretty hefty amount. I mean, we can see here they're lowering the dividend to an annual rate of 72 cents per share. This is a company that a lot of investors were holding for the monthly dividend payout, getting exposure to the renewable sector. They were typically paying $1.20 a year, 10 cents a month, and that had investors excited. Now, from my understanding, the revenues are pretty strong, right? Like, we take a look at the revenue here on the 9-month ending, 1.7 billion, pretty much flat year over year, up year over year on the quarterly basis, but they have been experiencing like major operating losses, like 400 million, like insane. And I think a lot of this had to do, from my understanding, with impairment charges to some of their assets, like their German asset, which I think is Gemini, a massive offshore wind project. And this company has just been struggling right now to get back into the realm of profitability. So it seems like the dividend cut was an appropriate thing to do, but I'm shocked they didn't cut it more, to be honest. Again, I'm not holding this company anymore. I'm not a big fan of it. It is held, I think, in VDY, my monthly paying Canadian dividend ETF, but this comes back to the mantra, guys, of cost average into the many, focus on the few, and don't make the few a vast majority of your portfolio, because anybody that was really leveraged in this stock today, I mean, is getting absolutely devastated. In contrast to Hydro One, and I'll remind you, this is why it's kind of more prevalent if you're looking for stable income, to focus on the mega cap utility companies. Northland Power is actually a fairly small cap. I mean, it trades for $5 billion, which isn't a small amount of money, but it is a relative small cap compared to Hydro One, that's like a $31 billion company right now that has a little bit more diversity and stability because they're not trying to expand around the world. They're not trying to expand into renewables that have a lot of fluctuations in energy generation. They're just a transmission and distribution company focused in Ontario, which is my home province in Canada. You know, you have the capital, like Ottawa's here, the major city of Toronto, and they offer 30,000 transmission line circuit kilometers. They offer 90% of Ontario's transmission capacity and 75% geography of province served by distribution, 126,000 distribution lines of circuit kilometers. Again, this is a huge company, and I like it because it's very boring. It's very stable. It's not cheap today. Their valuation has actually gone up quite a bit in this bull market. I'm not the big fan of that. I always said this is a good stock to buy on dips, and typically it does 5 to 10% corrections like every time it goes on a rally. So if we get another dip, you could potentially just keep buying it every time that happens. Regardless, if we take a look at the earnings, revenue here, almost 2.3 billion versus about 2.2 billion year over year. Take a look at the 9-month end, 6.77 versus 6.38. Again, there's nothing here that like screams major growth. This isn't a tech company, and the only reason to own utilities is just to stabilize one's portfolio. And I think you're better off owning the broader utility space right now, just because of the onslaught of AI, the electrification of everything, the use for transmission lines and hydro. I think over time we'll start to probably grow at a higher clip than what people are projecting. Hydro One, I think, will get some benefit to it, but it's really great to just own the sector as a whole. And I'm definitely underweight the utility space. And I've mentioned a few times that I've kind of traded in and out of pure utility ETFs, but I think it's a great way to stabilize a portfolio, and it's something that I've been looking at potentially re-adding to the portfolio. Again, great dividend growth when they came public. Another reason Hydro One's so great is it's a government spinoff, and the government still owns a big stake of it. But from 21 cents to 33 cents, again, not like the greatest growing dividend, but very stabilized, very consistent. In comparable, let's switch to another utility company, Telus. I mean, the monopolies that control our telecom space, which there are very few. You got Rogers, Telus, Bell. I think there's a Quebec Core, whatever, a smaller one that's up and coming, that's crushing it right now. But a lot of people, and I'm going to keep telling you this, I really feel as though this industry is bottomed. I feel like Bell, Telus, I think if you're buying into these today, it's the most opportune price points you're going to get. It's not financial advice. I don't own these directly. I do have exposure again through VDY, but I'm making this statement because cash flows are turning around. And I laughed kind of hard this morning because Telus cannot cover its dividend obligations. And this was just posted yesterday from BNN, but when you click on the link, it doesn't exist anymore. So I'm curious to why they deleted it. Because to be fair, they are getting very close to in line with their dividend. And I was shocked because they actually increased it, right? So if you take a look at the recent earnings here, which they stated they've increased by 4% to 41.84 cents. So they're claiming that they're able to do so because their free cash flow growth is up 8% and it's helping support the dividend. And again, this is one of the reasons I think you can confidently feel out that we're seeing bottoms because interest rates have come down substantially. They've done a lot of restructuring. And yeah, I mean, you're starting to see their free cash flow come back. So if their free cash flow continues to recover, and let me just do some quick math for you guys. If you take the shares outstanding and you divide it by that $611 million, their free cash flow is right around 40 cents. So, I mean, it's just below what they should be able to use to cover the dividend. So if that continues to increase, it's likely that they're actually going to have enough money to cover the dividend moving forward. And yeah, I don't think you need to be like overly concerned considering if the company was going to cut the dividend, they probably already would have. And it's likely that they know they can afford it in the future. And to keep investors kind of supporting the stock, they're going to increase the dividend. And that's kind of a signal to investors that, hey, unlike Bell, that was knowingly increasing it during a very bad time, I think Telus is strategically increasing it to tell shareholders their level of confidence and the return of their cash flows. And I like this company because, again, like you're still seeing telecom provider or, telecom connections growing by 5%, with healthcare lives covered in the millions here at 160 is very nice to see some incredible growth there year over year. Again, they do have the tech side of this as well with security. I mean, I just like Telus. I think, again, it's gone through the cycle now. I think we're finding the bottoms. Again, I could be wrong. It's not financial advice. I just keep stating this over and over, and we'll see if that turns out to be true over time. But yeah, really interesting earnings cycle we're currently sitting in here, guys. I'd love to pass the question off to you. Do you own these stocks individually? What are the few you're focused on? What ETFs are you cost averaging into? If you love VDY, XEI, XDIV, this has been one of the greatest periods in Canadian history for investing. I mean, we're outpacing the United States. I've been very excited and very enthralled by it all and just thankful to have exposure to this beautiful market. So I'll pass that question off to you. Let me know what you think. And as always, I look forward to catching you in the next one.